Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing podcast. As always, I am your host, Real Estate Cody, and with me again today, the coffee connoisseur himself, Mr. Brian Alfaro. Brian, good morning.
Good morning, Cody. Nice to see you again. Excited about the show today.
Man, me as well. And it's a perfect segue off of our last guest, our special guest we had on last week, talking about the good, the bad, the ugly about asset management. And that's a perfect segue into our very special guest today in our conversation. So tell us who that is.
Absolutely. Today we have Kartheek in the hot seat, and he is the managing partner of 6 Cents Equity. 6 Cents Equity is a general partner in two multifamily properties totaling 74 units in Hampton, Virginia and Columbia, Tennessee, and also 4 mobile home parks across the Southeast, totaling 528 lots. The firm also holds limited partner stakes in an institutional multifamily asset in the Dallas MSA and an industrial asset focused on the cannabis space in Michigan. The firm's core focus is value add Class B and C properties in Virginia and the Carolinas. In his W-2, Kartheek has been a finance and operations executive at technology-focused companies ranging from early stage to public. He was previously a venture capitalist and an investment banker. Over his career, Kartheek has worked on 25 plus mergers and acquisitions and capital raising transactions totaling nearly $2 billion in aggregate deal volume. Kartheek, welcome to the show.
Yeah, pumped to be on, guys. I've been tracking your journey, been listening to your podcast for the past year, and it's great to finally be on.
Well, we appreciate that, man. Thank you so much for tuning in. It's been great to get to know you over this past, man, I guess it has been a year, huh?
Yeah.
And just watching your journey as well. So, excited to have you on and really been impressed with, your story and your momentum. And so before we get things kicked off here, why don't you tell the listeners a little bit more about your background and how you found yourself into the commercial real estate space?
Yeah, so as you guys mentioned, I've spent most of my career in the technology space, mostly in finance and operations functions. So started my career in investment banking, advising private equity firms, companies on M&A and equity raising transactions. I transitioned from there to venture capital for a couple of years, funding early stage companies. And since then, I've held finance operations and executive leadership roles at 3 different startups, currently at a public company. So I've seen the gamut. Around 2018, just realizing my journey up until that point. I wanted to continue working in tech, but also start getting access to a more stable asset class, and that's it's around 2017, 2018 when I discovered real estate, read a ton of books, listened to a bunch of podcasts, and there are a million things that you can do out there in the real estate space. At the time, I was working at an early stage company. I was based in New York, and after diving into all the different paths out there, realized that multifamily syndication and investing in those was the one that made the most sense for me at the time. And so I made my first investment as an LP in a deal in Dallas back around 2018. It was around late 2019, early 2020 that, I realized that, I wanted to get more active in the space. And, with COVID, breaking out in, February or March, my wife and I moving to Northern Virginia, which is where I grew up, realized that it was a perfect time to get more active, was closer to, cash flowing markets as well, which, I think is a nice thing in this space. And so when started to go full bore at it around the beginning of 2020.
Awesome, man. And it's been paying off dividends for you, as I think Brian alluded to earlier, man. You got your first acquisition down this year, and then we're going to hopefully dive into it a little further, but you got some other great things in the works. And but before we kind of go down that path, I really want to talk about your background in the venture capital space, investment banking space, and how that compares to what we do in the syndication space here in the commercial real estate. Are there, looking back, are there any similarities between the venture capital world and the commercial real estate space when it comes to raising capital and bringing funds together to do these acquisitions?
Absolutely. Like the general, generally executing on a deal, there are commonalities, right, that are applicable to any deal. And so those port over, whether it's real estate syndication, whether it's advising on an M&A transaction or setting up a joint venture agreement with a major corporate. So that definitely translates over. In terms of the capital raising side, there are similarities, but there are major differences, right? So in the venture capital space, investment banking, you're working with institutions, and so the way that you're going about the capital raising, it is fairly different from raising from retail investors in the syndication space. With the institutional space. Investors, tend to need to see a lot more analyses, and sometimes, you'll have 4 or 5 rounds of conversations with the founder as a venture capitalist before investing in a company, right? And you might have your initial conversation, then you introduce them to a couple of partners you work with, then you bring them to your offices to pitch to the entire deal team. And you'll put a memo together, and end to end, from first meeting to close, these processes can take several months. In the real estate syndication space, as you guys know, right, you take a property under contract, and then you've got 60 to 90 days to close. And so, yeah, you're digging in with retail investors, informing them of the opportunity. But it's a more streamlined process that I'd say in the syndication space versus the institutional space.
But it sounds like I'd imagine you've picked up some really good skills there as far as, whether it be presenting an offering or an acquisition, going through that process of multiple different discussions with the venture capital teams. I imagine you picked up a lot of great skills or transferable things that you can take and bring to the syndication world when we're talking about, dealing and interacting with the retail investor, so to speak. Would you agree?
Absolutely, right? Because when you're an institutional investor, you're investing millions of dollars into companies. You learn how to become an investor, right? Because these are major decisions that your company is making. And so, understanding, the general process of diligence, all the things that you want to dig into, with the company, the process, all the things to tackle, how to tackle those aspects, putting together a memo, understanding for yourself, where the opportunities are with an investment, that stuff all translates over to this space. And so, with the deal that we did, I was able to use those learnings from years of, institutional investing, advising companies, and then also raising capital as an operator to execute on, ultimately closing this opportunity.
Yeah, we always talk about this a lot, Brian, right? Where capital raising, it's a skill set, and you have to learn how to present an opportunity, but in a way that's not coming off as sales or pitchy or anything like that, but in a way that's connecting with people, and that you're providing a value or a service that are solving a solution for somebody else's problem. And that, what is that? Looking for alternative investments, right?
Yeah, it's definitely about knowing your audience, right? If you're pitching an institutional investor, you got to, as Kartheek mentioned, you got to know who you're talking to, and they're going to want the process, to be taken from beginning to end. They're going to want to meet the operator. They're going to want to go through all the due diligence, and they're going to want to do a real deep dive, not only on the people, but on the actual business plan, the numbers, the analytics, the data, the assumptions that are made throughout the life of the process. And in a retail investor, they're going to want to see that too, but it's definitely a lot of, we say this all the time, you're betting a lot on the jockey as well. So they want to know a lot about the operator. They want to see your track record and all those things. So having your presentation ready and being professional and organized and knowing who you're talking to, I think is one of the keys to being successful in raising capital, whether you're dealing with an institutional level partner, whether it be real estate or not, or you're dealing with, just a private investor who wants to place, $50,000, $100,000 of private capital.
Yeah, guys, to that point, one of the key learnings that I learned early on in venture capital was the importance of betting on the jockey, right? Because when you're betting on an early stage business, these businesses typically haven't found product market fit yet. And it's not rare, right, that they'll pivot their businesses, and sometimes entirely pivot their businesses, right? So the business that you might be investing in today, it could look very different, right? 2 to 3 years afterward, right? And you really, and what really matters is the team that's driving that business. And I think that applies to this space as well, right? That you want to work with people that know what they're doing, can navigate tough situations, and get through them to, ultimately deliver excellent returns for their investors.
Yeah, you're absolutely right, Kartheek. It's important. And so, looking back at your background, you said you started as a limited partner, which I'm sure you got to see a lot of this firsthand, right? The business execution, the operator, how they're putting the deal together, how they're managing the deal and such, how they're communicating with investors. And then you saw an opportunity to pivot and really become more active, which I feel like a lot of people getting into the space, that is their interest, right? They want to be on the active side. But the reality is man, it's a ton of work. And if you go back and listen to our previous episode we were just alluding to earlier from last week, there's a lot of the good, the bad, and the ugly that come along with, acquiring these assets and actually being able to execute. And that's the part that you don't hear enough about. So I'm really excited, if we can, to dive into, your story of your recent acquisition this year, because I think it's very relatable. I know that you guys have been through a lot to get that deal done. So let's kind of start from the very beginning. Tell us, how the deal came about. Where did you find it? And then how did you put the team together?
Yeah, so let me start with kind of when I met my partner, right? So I met my partner, Keith, in May of 2020. At the time, he had around 50 units under his belt, all multifamily, but smaller multifamilies. He was at a point in his real estate journey where he wanted to scale his multifamily investing, and realized that he had his strengths. He's a really good asset manager, but realized that he needed someone that could help him streamline acquisitions, on capital raising, and with general underwriting. And so we found a fit working together over the summer of last year. We worked through several deals, underwrote several opportunities, put in a bunch of offers, but for some reason or another, none of those were accepted. Right? Primarily, valuations, as you guys know, have been quite high in the space over the past year, 2 years. On top of that, during the summer last year, volume was lower, and so. Around September, so we took inventory of all the broker relationships we had in the market. Realized that there were a couple of brokers that my partner had relationships with that we hadn't spoken to over the past several months, and so we reached out to those brokers in October of last year, and at the time they were getting ready to take a 42-unit property in Hampton, Virginia, to market, and so. They had the financials, they had the D12, they had some pictures, but they were still in the process of putting an OM together. And so we got to take a look at this deal off market. We were, I think, one of the first teams to take a look at this deal. We ultimately put in 2 offers in Q4 of 2020. Neither was accepted, but once we got to January, we put in a third and final offer, which was accepted. And the way we set it up was kind of financially engineering to backing into an LTC loan from a bank, right? So we push higher on the gross purchase price, but we got ourselves we signed ourselves up to get a significant seller credit at close that would not only fund deferred maintenance that we had noticed on the property, but also our value add CapEx budget. And so, it's January 2020. We executed the PSA in, I want to say mid-February or so, mid to late February. Got on the property in March of 2021, and realized that there was a lot more deferred maintenance on the property than we had originally thought with the inspection. And on top of that, we noticed too that the number of units that the seller had said that had been renovated, it was a lower count than we thought. And so we had to ultimately set up a retrade with the seller. And so, we had roughly a month and a half of negotiations back and forth with the seller, different proposals. What helped out here with having, what is always a tough conversation was documenting exactly piece by piece what we had found that had not been, available to the naked eye, right? So, the miscount in the number of units that had been turned, other things that came up with the inspection, and just itemizing it, and working with our inspector, working with vendors to figure out how much would it cost to remediate each of these pieces. And we stuck to our guns to push for the credit, right? Because these problems had come up in the first place. So we didn't, we would have preferred the credit versus the seller trying to repair these items on their own. But ultimately, we stuck to our guns as well, because during the process, we were getting updated financials from the seller. We were seeing updated rent rolls, and this is a property that was struggling through COVID. They were working with a property management company that was more used to managing Class A, B plus assets, also co-living sort of assets, and so they didn't know how to manage a Class C property. Right. And so we were the ones that actually educated them about rent relief programs that were available in Virginia through the process. And, they started applying on their own, which helped them out a bit. But still, we saw clearly that it was a case where, the property management firm was not equipped to, tackle this asset. And, the seller, really want to get out of this asset. Right. And so, we stuck to our guns and ended up getting most of what we were looking for in the form of the seller credit. And, at the time we held off on executing a term sheet that we had received from a local community institution because we wanted to figure out the seller credit first and make sure that, that was moving forward, right? That wasn't going to be a deal killer. And so around April, we ended up executing the term sheet with the bank, ordered the appraisal, ordered the environmental study, all the things that community institution is going to look for. And the appraisal came back in early May of 2021. The appraiser valued the property on an as-is basis versus an as-completed basis. And so they didn't take into account the fact that in the LOI, we were getting a very significant, or with the PSA, we were getting a very significant seller credit, right? And that we would use these funds to drive the value of the property upward, right? And on a net basis, with the seller credit baked in, the price was ultimately a good chunk lower than where the appraisal came in at. But because the appraisal came in at the value that it came in at, the bank would not take a second look at this. And so in short order, we worked with the seller to renegotiate the deal, got to keep most of the seller credit actually, which was great for us and which is great for our investors. Ended up meaning that we had to raise a bit more capital because more of the CapEx had to come out of pocket versus using the seller credit. But got to a point where we had a deal in place. The bank approved the loan, and so we thought it's early May. We're moving forward to an early June close. But as we're going through the closing steps, a couple of things came up with the bank. Most notably, the day before the deal was set to close, the bank informed us that they would not be able to close on time. And so we're like, oh shoot, okay. We're going to be technically in default of the PSA. So, the seller can, seize our deposit and walk away if they want to. But at the same time, we understood, right, that we were kind of at the 1 yard line. This property had continued to, struggle, and the seller was, looking to move on from the asset. And so we were able to strike a deal with the seller where, we're penalized for each day that we wouldn't, that we couldn't close on time. But luckily we escalated, this to a senior executive at the bank, and he was able to, work with folks internally to get the deal closed a few days later. So we took over the asset in mid-June. And we've been running our value add strategy on it over the past few months.
Wow, there's so much to peel back there, Cody. I mean, there's so many nuggets in that story, and I think the big takeaway from this is kind of alluding back to that episode we did with Ben. Is this is not from the faint of heart, right? This is a really hard process to go through go through acquisitions, and to just take the thing to close is a chore within itself. So I definitely appreciate you sharing those, and definitely a lot to peel back there.
Yeah, absolutely. I mean, if you look at the timeline, you had 2 offers out on this property in Q4 of last year. You got the 3rd and final offer Q1 this year, and then you finally had takeover in June. I mean, that's at least easily 7-8 month timeline from, concept to finally getting the keys. It's a long time. Most people would not stick it out that long. So I want to let's go back and dissect, because I've been taking notes as you've gone through like all the different hoops and challenges you guys had to go through. So first off, what was the motivation? Like, what was the key characteristic of this particular asset that made you want to continually pursue? Again, you ended up submitting 3 offers before finally getting one accepted. Why? What was it about this asset that made you stick with that?
Yeah, so let's start with the market. We were really high on the city of Hampton. The Hampton Roads, from 1,000-foot view, is the market that the city of Hampton is in. And Hampton Roads is a top 40 MSA, roughly a population of 2 million people. Super steady. It's not going to grow like Atlanta, Charlotte, and many Southeast markets are, but it's larger than Southeast markets that have been getting a lot of attention, like Jacksonville, like Raleigh-Durham. And, you have a massive military presence there. And in addition to the military, that brings defense contracting jobs. And it just brings a lot of stability to the region, right? Along with the academic institutions that are there, such as William and Mary, Old Dominion, Hampton University, and a number of others. And then you also have 4 Fortune 500 companies that are based there, including Dollar Tree. And kind of with that backdrop, the Hampton Roads was actually one of the first markets to start showing signs of recovery from COVID, really started to bounce back in the middle of last year. And on top of that, the city of Hampton, put up the strongest rent growth numbers in the market in 2020. And from what I'm seeing so far, that trend is continuing in 2021. There are a lot of things going for it. In addition to having a massive NASA facility, Langley Air Force Base, and a number of corporate jobs there, there's a major infrastructure project that is going on that is connecting the city of Hampton to the city of Norfolk, which is one of the more known cities in the Hampton Roads. And connectivity has been the big problem in the Hampton Roads. So having the infrastructure project expanding the size of the bridge connecting the two, we think that longer term, it's going to be a real boon for the city of Hampton. And so we love the market to start with. Second, with the property, it was situated in a very good area, right? Less than 10 minutes away from the retail center of the city, basically the city town center, less than 10 minutes away from Hampton University, and then less than 10 minutes away from shipbuilding facilities, shipbuilding centers. So centrally located, easily accessible to the highway. The other thing that we noticed too is, these were all, except for one unit, 2-bedroom, 1.5 bath garden style townhomes. And, you generally look for, buildings with, 2-bed or, 3-bed units, right? Because in theory, those tenants are going to stick around longer than folks renting, 1-beds or studios. And so essentially the unit economics with, a 2-bed or 3-bed mix end up working out better, all right, in terms of, the long-term value of those tenants to you. So we love that aspect about it. And, we noticed too, right, that there was very obvious value add to be applied to this property. Units that had been renovated by the existing owner, we noticed that they were getting pretty sizable rent bumps on those renovated units. They'd only made their way through, a portion of those units. So the strategy was there to tack on a platter. But even at that time, we knew too that the ownership group, prior to us, they were struggling with collecting rents from the tenants that were at that property, right? And so we were able to get the property on a discounted basis relative to, say, a situation where the tenants were, paying on time. So we felt that the cost basis we were getting the asset at was great, and left us more meat on the bone ultimately to execute on our business plan and provide a great outcome for our investors.
So Brian, I want to go back and talk about, your first key points you mentioned there is the importance of market and location, right? And for us, in real estate, it seems very rudimentary, right? That's just fundamentals. But, for anybody that may be tuning in for the first time and really figuring out, hey, where do I start? Those two factors are so important, because ultimately you can have a nice, beautiful asset that is sitting in the middle of nowhere, and you're going to be at a very high risk exposure. So the importance of being well seated in a very strong, stable market, like you mentioned, is so important. And I'm glad you alluded to Hampton up in Virginia. Probably not a market that most people hear about, but the point of that is there's plenty of good, stable markets with positive fundamentals or positive growth that you can find, like you mentioned, a lot of good cash flowing opportunities. What do you think, Brian?
Absolutely. Yeah. I think you really understanding the market is the theme of this segment here is, everybody is, when you're first getting started, you're sometimes attracted to the super large MSAs because you think, that's where your money is to be made. But, we've seen from other really high quality operators in our network, you can still make money and do a phenomenal job operationally as well in some of these secondary and even tertiary markets nowadays, as long as the market, the fundamentals, what can be pushed and what can't. Your tenant base that's going to be in there. And then ultimately at the end of the day, you're just willing to be persistent as Kartheek was throughout this transaction process, because all the dirty details of the market, that being persistent is going to pay off in the long run. So understanding your market is definitely something that can't be taken for granted. And it's definitely somewhere to start, right? You see sometimes these beautiful assets that come out from brokers, and or maybe they're pushing, the OM, and it has these great numbers on it. And then you see it's in some market or some section of a market, a sub-market within your MSA that is just not attractive at all. And it doesn't matter how pretty the building is or how much, quote, value add there is to add. If you're not in a good market or an up and coming market that has positive fundamental growth, you're going to have a really hard time no matter how good your operations are.
Absolutely. Absolutely. Well, Kartheek, let's go into the next important point. So you have the market, you found an opportunity with a good value add component. You saw some upside potential there. Next is probably the most important part of the deal is the debt, the leverage, right? So What was the decision, or why was the decision to go with a local community bank versus maybe a bridge or agency debt? And talk to us a little bit about how you ended up structuring the debt on this deal.
Yeah, so this was a 42-unit deal that we bought for roughly $3 million. So, small for agency, right? And, there were a couple other reasons why we wouldn't have gone with agency anyway. The occupancy had dipped below 90%, during the transaction period. So it wouldn't have qualified anyway. And then on the bridge side, maybe we could have found a bridge lender or two, but, what we learned was that bridge lenders typically look at larger assets. And, keep in mind that, this transaction was going on at the beginning of the year. And, bridge lenders were still, uneasy about the direction that, they wanted to go in at the time. And so, community banks, community institutions, last year, they almost became, bridge debt for many investors, right? Because they were out there, underwriting deals, making things happen, while agency and bridge were frozen. And we had the confidence on this one just based off of what we saw to take the recourse debt that typically comes with community institutions on the books ourselves. And so the terms we got 80% LTV, we got an year only, interest only period. And we also got, I think I want to say a 3.65% interest rate. So all great terms, and all terms that, really helped us to, put, what in our minds was an optimal structure on this project.
And you mentioned that was a recourse debt as well, right?
Yep, recourse debt.
Awesome. So you finally, after all of the renegotiations, the appraisal issue, the the lender at the very last day saying, hey, we're not ready to close, all of that, you got the debt finally in place. And I would agree, those are pretty attractive terms, especially historically, community banks haven't always been able to be that competitive. So I think they definitely capitalized on the opportunity last year. Then it comes through going back to the actual negotiations with the seller. You're finding, things like the lower unit count, extra deferred maintenance, things like that. What were those conversations like, or those negotiations like with the seller back and forth? You mentioned there was about a month and a half of negotiations. Then you had to renegotiate the deal when the appraisal came back lower.
Yeah.
What were all those conversations like, and what was the seller's perception of those conversations?
Yeah, so what I've learned over my time negotiating deals, whether fundraising, M&A, or JVs, is I like to use a data-driven approach to my negotiations. And so, in this case, my partner and I, we put together a very detailed spreadsheet with all that we found. We also shared a very detailed inspection report that our inspector had put together, right? So we were able to use evidence and proof to back up, what we were looking for. And, we did the back and forth through the broker. And early on, we realized that, they weren't coming back to us necessarily with a data-driven approach, that it was more, okay, they're asking, $10,000 for this, let's just give them half of that, right? So not taking a look on their end and, defending, the assumptions that we were making. And so we noticed that, and then we also again noticed that the property was continuing to struggle. So the seller wasn't negotiating from a strong position either, right? So we felt that we had the momentum on our side, and because we were seeing these two things, the lack of proof behind the counter arguments that the seller was making, along with where the condition of the property was sitting at, that we should stick to our guns and look to get at least most of what we're looking for.
Was the concern ever in the point of those negotiations, especially with being persistent on sticking to the concessions that you were asking from the seller, or credits, however you want to label them? Was there ever a concern that, hey, at any point in time, if we take too strong of a position, that he could potentially just back out and walk away, and then we lose the opportunity?
There was, totally was, right? So that was a risk that we were taking with this process. But at the same time, right, when this is a syndication that we were raising capital from a set of limited partners, and so it was our fiduciary duty to make sure that we could get most of these concessions in order to move forward with the deal in the first place, right? So that we would have the reserves, we would have the budget necessary to execute on our plans. So it was a risk that we were willing to take, but just kind of seeing the seller's position and being open with the broker, and understanding that there were dynamics here that favored us. That helped us to kind of weigh the risk and stick to our guns.
Sure. And in those negotiations, I'd imagine that you probably were trying to create still that win-win scenario for both sides. Obviously, you were protecting your interest and trying to acquire the deal, which made sense for you guys, but you're also still trying to focus on how do you get the seller's position, or how do you get his problem solved, right? Which is ultimately trading the asset. I'd imagine those negotiations still had that component, even though you were using your data-driven metrics or whatnot, the discoveries that you found in your due diligence to push back, but you were still trying to solve the problem for the seller, right?
Yep, we were. And so, the way that we kind of line itemed, what we were looking for was internally, we were figuring out, hey, what is primary for us? What do we have to fix no matter what when we take over this property? And what's secondary to us, right? And then we would also point out things that would be nice to have, but we include them anyway. And in our request list, we showed them like, hey, these could be fixed, but we're not asking credits for these pieces, right? So we're, effectively anchoring high. but making some concessions on our end from the start, showing them that we were being reasonable. I think that helped in the process. And so as we went through the process, we held to our guns on the primary stuff. On the secondary stuff that were kind of nice to haves, or might need to be fixed, say 3 to 4 years out. We took reductions on those in the negotiations, and so we were able to come to that middle ground, by piecemealing it in that sort of format.
Sure. Yeah, Brian, what do you think? I mean, I think it's important, when, again, obviously as buyers, you want to protect your position, right? You want to protect your interests as well. And you want to buy right. I mean, that's ultimately our goal. But at the same time, in these negotiations, when you're working with sellers, it's important to realize that there's two sides to this story, and that both sides have to come out with a winning scenario in order for it to be a successful transaction. What do you think, Brian?
100%. Yeah. And I think what's super important for other people to consider as well, especially if you're maybe a newer buyer or a newer operator, is your reputation as well, right? You don't want to build this reputation as a buyer as somebody who is sort of constantly looking intentionally to retrade after you go into LOI or your PSA is executed. So I think doing it very gracefully, like Kartheek did, taking that, I really love what you said earlier about taking the data-driven, the analytical approach to your reasoning. This wasn't like, hey, as soon as you sign the dotted line, boom, here's a list of stuff I want to credit for. This was more like, hey, we did our due diligence and here's what we found. Here's the data we found. Here's, we've got some numbers to sort of back up our reasoning, and there's logic and reason behind that. So it takes a lot of, it's not impossible to remove it all, but it takes a lot of the emotion out of the seller. And also from your standpoint too, to be like, look, we're being professional, we're being transparent, we're not making this stuff up here. And that's the reason behind all of our requests here. So I think, the broker is definitely going to value the relationship a lot more when they know you're taking that approach, and the seller will as well. At the end of the day, when it's all said and done, hands are shaken and money is exchanged and the deal closed, you want to be able to say you were a good buyer just as much as they want to be able to say they were a good seller. So I think, following that win-win approach, trying to make sure you can do as much as you can based on your investors, like you said, have that fiduciary responsibility to, get what you can, but at the same time, making sure that everybody feels like, they sort of won in that situation, and everything that was renegotiated, if needed, was completely just based on the data. So I love everything about that. I know that's the approach we definitely try to take as well when, getting in those situations.
Yeah, and on top of that, right, with the renegotiation, right, we wouldn't include items that were, open to the blind eye, right, sure, on our basic walkthrough. So if, we saw, for example, that one of the roofs needed to be replaced, we didn't ask dollars for that, right, because, that was, obvious to the naked eye, along with a number of the HVACs. And so we made sure to kind of segment those out, I itemize it on the list, but we were very clear that we were not looking, for dollars to, fix those items.
Yeah, good point. All right, Kartheek. So we have the market, we have that deal, we have the debt now in place, all the negotiations back and forth, finally have agreed upon, closed terms, so to speak. Now the important piece is the equity. Now you got to go raise the equity, right? So talk to us a little bit about how you structured the syndication model, the equity raise in total, and let's dive into that.
Yeah, so the equity raise was roughly $1 million. We knew that it was going to be a syndication from the start. We were deciding between the 506B and the 506C structure. We went with the 506B approach. So, my partner, his company, and, my values too, we think that real estate, we have the mission of making real estate accessible for folks that it otherwise would not be accessible for. And so the 506B designation, it allows you to, raise money from non-accredited investors as well, folks that are sophisticated investors. But, it's important that you have to have a pre-existing relationship with these investors, prior to the offering, right? And so we ended up going to a lot of friends and family, a lot of folks that had been tracking our real estate journeys to raise these funds from, and it's worked out pretty well as a result.
Good. Yeah, I like the way you said that. And this is something important, right? Is making real estate accessible to the sophisticated or non-accredited investor, because I think, there's plenty of people that understand the power of investing in real estate and they would love to, and these opportunities fit their investing thesis. But, a lot of guys are chasing the 506Cs and they're looking for those accredited, those high net worth individuals. And so it makes it hard for, sophisticated investors to break into the space. And so I really like that. I'm glad that that's your basis. But talk to us a little bit about the thought of why did you know automatically that this was going to be a syndication versus maybe a joint venture or, whatever other transaction?
Yeah, so the $1 million check size, I'm sure it could be structured as a joint venture in some cases, but kind of taking a look at the capital that was available around the table, to the partners, we just felt that the syndication made the most sense at the time. And, there's a bit more legwork that you have to do with the syndication, right? Hiring a syndication specific attorney, working with the SEC, filing, for blue sky exemptions with the different states that you're, raising capital from, and just maintaining a larger sense of compliance relative to the JV. But that was all items that, we felt comfortable with, items that, I'd gotten used to, right, based off the institutional experience that I had picked up over my career.
Mm-hmm. Yeah. And can you tell us a little bit, are you comfortable with disclosing how you guys structured that equity? What was the equity split between the GPs, LPs? Did you do a pref, straight equity?
Yeah, so it was pretty standard. So 8% preferred return, 70-30 pref, or sorry, 70-30 split between the LPs and the GPs.
Awesome. And just curious, why go with with that particular structure for you guys?
Yeah, so for us, we projected that especially once the property was stabilized, we would be able to generate really healthy cash on cash returns, and it would be higher cash flowing property. Same time, given that this was our first syndication as a group together, we did want to give our investors a bit more of the upside with the equity. So we felt it was fair to give them a 70% split, right? With us taking 30%.
Yeah, I like that. Putting the investor interest first. That's important, man. That's what our job as capital raisers are about, right, Brian?
That's right. Yeah, structuring the deals based on what your investors are looking for is super important. You got to keep that in mind, right? So obviously track record plays a big role in that. And when you're just getting started, those 70-30s, those 80-20s, those make a lot of sense for the operator. So you can give the investors confidence that your interests are ultimately aligned. So I definitely agree with that.
Yeah. Any surprises through the equity raise, Kartheek, that you guys ran into? Any challenges that you ran into? Was it a smooth raise?
I would say it was a fairly smooth raise. It was, fun doing the webinar, right? Marketing the opportunity and informing about the opportunity, answering questions about the opportunity through it, right? So, I had done, items like that in the past, my institutional career, right? So in front of an investment committee, defending an investment. So it's fun to do it again, but in another context.
Sure. Yeah, those webinars are really fun to participate in, especially when you're the ones leading it, right?
Yeah, and we had a lot of good questions too from our investors. So I appreciate the back and forth with investors during a webinar.
Well, listen, I mean, ultimately, when you're talking about presenting an opportunity, you need to be the deal expert, right? You need to know all the details, and you need to be able to answer those questions or have the confidence to direct the investors to the right resource to get those questions answered, even if it may not be you specifically. But you definitely don't want to be the deer in the headlights, so to speak, if you're getting investor questions, because that's not going to instill that confidence in your investors, because ultimately they're investing with you, right? It's not about the deal. They're investing in you and your expertise. And so very, very important. So, all right, man. So we got, now we have the equity in place. You got the keys. We finally get to the closing table in June.
Yeah.
Talk to us a little bit about what happened after takeover. What was the strategy out of the gate as far as execution, priorities day one from takeover?
Yeah, so we took over in mid-June. The eviction moratorium was still in place, and as you guys know, it was extended a little bit longer. Currently, the moratorium's over. So our position of turning over the tenant base it was a bit slowed down early on. We were successful though, making cash for keys offers with a couple tenants. So we were able to move a couple folks out. We have applied for rent relief with the state's relief agencies. And we think, we'll get a number of dollars back from the state. But the units that we've been able to get access to and, we've renovated, we've been getting much higher rents than we had originally projected. And so we think that the upside of the property is ultimately going to be a lot higher than what we underwrote for. So we're super excited by that. And, with the moratorium up, and Virginia still has certain laws in place around, say turning over a tenant base. And we're abiding by that. But yeah, we think that, year one, it's going to be spent, turning the tenant base over, renovating units, improving the quality of the community, and stabilizing it hopefully by the middle of the summer next year.
It's always a great feeling, right, Cody, when you take over an asset and you're projecting $100 of rent growth and you end up getting 110, 125, or sometimes even more, right? So this just goes to show you the power of, sort of being conservative, taking what the market gives you, and then you're going to have opportunities where, you realize you can push the needle a little bit more. And those are always the whipped cream, the cherry on top. So that's always fun to hear.
Absolutely. Yeah. Absolutely. And, Kartheek, talking about, how you guys are navigating through the eviction moratoriums, helping your residents with rental assistance, rental relief, whatever the case may be, like navigating these uncharted waters, so to speak. I think this is really going to really highlight the operators who really know how to be creative in managing their operations, right? How are they navigating through these difficult, challenging times? And ultimately, that's what, that's been the message over the past couple of shows, is really, the operations, asset management, and being top-notch operators, which a lot of it is problem solving. And it sounds like from the gate, from day one for you guys taking those keys over, you've come in just in the mode of problem solving and how do you get through each of these barriers.
And what I will say too is that what we learned speaking with tenants, during diligence, but also after takeover, was that some of these tenants weren't paying rent just because the private ownership group wasn't addressing their maintenance issues, right? And things were building up, so they felt that they didn't want to pay rent, right, because they weren't being taken care of. And so we got in, took care of their issues. And some of them have become, quote unquote, good tenants as a result. So it's been great seeing that turn around too, in terms of what tenants think about the property that they live in.
Well, you said this perfectly a minute ago. It's about improving the quality of the community. And I think when you show that and you make those improvements to the community and your residents see that, it's going to make them want to stay. People want to live in a community that they feel safe and comfortable in, but they can see the service that you're providing. And that's a responsibility, I think, as owners and operators that we have, is it's not just about the dollars. Yes, we're in this business to make money, but ultimately we want to use this power that we have and this opportunity that we have to really impact and improve the qualities of the lives of the residents in our communities. And I think ultimately that's what creates a great business for you, and great reputation. So I think that's so important. And I think that's a great takeaway here. So, Brian, what do you think, man? It's a lot of great information here through this case study. And I mean, looking back at the highlight again, 8 months of negotiations from start to finish, challenges in due diligence, challenges with the lenders, finally getting the keys, challenges with cleaning up the resident base. The theme there is it's a lot of work, man. It's to reemphasize the point, this is not for the faint of heart, but it's worth it if you stick to it. But
absolutely, yeah. I mean, I love episodes like this, and really appreciate, Kartheek, you coming on and sharing this. No matter if it's a 10 unit, a 20 unit, a 40 unit, or 400 unit, the reality is this is not easy, and we tell people this all the time. If you really have to take a step back, if you're interested in multifamily real estate investing or just real estate in general, and ask yourself, how active do you want to be? And also, what's your stress tolerance level? We always talk about your investing thesis and your risk tolerance. But what's your stress tolerance too, right? This side of the business isn't necessarily for everybody, right? Some people are better off putting their hard-earned money to work with other operators, such as Kartheek or such as us, in the passive sense, and spending some upfront legwork, doing due diligence, vetting the jockey, vetting the asset, vetting the market, doing all that. And at the end of the day, if they make all the right choices and decisions, and the business plan goes accordingly, they get that passive income, right? And the tax benefits and appreciation. So stories like this are super valuable because it just reminds me, and it reminds, I think, our audience, those that are maybe interested more in passively, or maybe those that are on the fence, they have to stop, look in the mirror and ask themselves, am I willing to go through a situation just like Kartheek, where it takes me 6, 8, 9 months to get one deal closed, and then to deal with the challenges that sort of come along with it. So definitely valuable insight that you don't want to take for granted.
Yeah. Kartheek, really appreciate that. I echo Brian's sentiments, man. I think this is where there's so much good value in hearing case studies like this from you, because it's the behind the curtain scenes, like we alluded to earlier, right? Where the acquisition is the piece you hear about, but you don't hear what it took to get to the keys. And so we really appreciate the value that you've shared with us today. I mean, we've gone through a lot. I think we could go another probably an hour or so or more talking about just other topics we haven't even discussed. But what we should do, Brian, is have Kartheek back in about 6 months, maybe a year after takeover, just to get a update on this case study and just keep going down this path, man. This has been great. So
and I will say, right, like going through this process, it got frustrating at times, but looking back on it, I feel that I got, several deals worth of experience in one deal. And it's just, kind of seasoned me as an investor, quite a bit, right? Just going through, all the different things that came along in this deal. So other operators out there that are going through something similar, you might be frustrated in the moment, but definitely reflect on what you're going through, and it'll make you better as an investor too.
Absolutely. Well, this is where you learn, right? By taking action. You got to put yourself out there. You can only do so much studying and so much analysis, but eventually you just got to take that leap of faith. You got to put yourself out there, knowing you're going to take those bumps and bruises along the way. But if you're willing to stick it out, it's going to pay off tremendously for you. So really appreciate the great insight here, Kartheek. This has been awesome. But so we're going to wrap up here. We got a few more questions for you, and then we'll end the show there. But we love to find out from all of our guests, what do you like to do for your continued education to further your own investing?
Yeah, so a couple of things. I love listening to real estate podcasts such as yours, right? So as you guys have mentioned, and as you see from the guests that you have on, everyone's going through different experiences. And so it's great to understand case studies, right? How so-and-so might have handled this situation or that situation, because, there's a possibility that you can apply their solution to, what you're going through. So I think that's one way to become a better investor, as well as, just speaking with, other folks out there, networking in the space. And finding mentors, right? So through our process, we did reach out to several folks who had a lot more experience than us, asked them how they navigated that situation, and by asking several folks, we got several data points back, and we effectively got several options, right, of how to pursue a given course. So I think those are two key things that are very important that every multifamily operator should do.
Absolutely. Well, looking back on your path so far, Kartheek, was there a moment in time or a particular event that changed the trajectory of your business?
So yeah, I would say that COVID hitting, right, was something that changed my trajectory, right? Because up until that point, I'd been a passive investor, limited partner, and with COVID hitting and the ability to work remotely and moving down to Virginia and getting close to cash flowing markets, that helped me to become more active as an investor. So it's COVID's obviously been a very unfortunate situation for us as a society, as a country, but it caused things that happened in my life that allowed me to get more active.
Awesome. Well, glad to hear it ended up being positive for you and making some big things happen. So any advice that you give to listeners to help them grow their businesses?
Yeah, so a couple things, right? So each one of us has a set of experiences that we can rely on, right? Even for those of us who are relatively new to real estate. So I would try to figure out what your strengths and weaknesses are, and use those strengths and weaknesses to build as ideal a team as you can build, to tackle a project, right? So multifamily, it is a team sport. You see some cases of it where one person is wearing every single hat to execute on a deal, but that's rare. I feel that the probability of succeeding is better when you work as a team. So yeah, try to build a team where you have your strengths, you can utilize your strengths, but then stuff that you're weak at, you have someone on your team that is strong in those areas, so that you're covered from end to end.
Great advice, man. Great advice. Appreciate that. All right, Kartheek, tell the listeners how they can learn more about you and connect with you.
Yeah, so you can visit my website at sixthsenseequity.com, or you can email me at kartheek@sixthsenseequity.com as well. I'm happy to take on any questions.
Awesome. Well, Kartheek, really appreciate your time, man. Thank you so much for tuning in with us today, and look forward to hearing some updates on this project as you go along.
Sounds
Thanks,
good,
Kartheek.
guys.
Thank you.
Thank you.